Last week, the Wall Street Journal reported on the widening gap between spending and taxes, which is on track to give us a deficit this year of almost $2 trillion. The journal worries that this gap is increasing not because of the economic cycle, but for structural reasons that could make it permanent. Meanwhile, researcher Luke Groman gave an interview on Wealthion worrying the, quote, toxic combo making those historic deficits could crash stock markets. The issue is that we are running a deficit of 9% of GDP, which has never happened with unemployment this low. That sounds like a good thing, but it's actually a very bad thing because it means that 9% is structural. It's not a temporary thing during the recession, it is built in. Meaning when the recession hits full force and unemployment skyrockets, the deficit will explode. Because remember, the deficit is made of two parts, spending and tax receipts, and both get much worse in a recession. Millions of people lose their jobs and need help, but falling incomes and profits drain tax payments, so the deficit balloons. In other words, from an economic perspective, we are running, in Luke's words, quote, wartime deficits in a peacetime economy. To illustrate, we can take our last three recessions. In the 2001 dot-com crash, we went from a surplus of $200 billion, that's 2.3% of GDP, to a deficit of $400 billion, so a drop of nearly 6% as a percent of GDP, or $600 billion. It was much worse in the 2008 financial crash. We went from a deficit of $160 billion to a deficit of $1.4 trillion. So that was almost 9% in GDP and $1.25 trillion in actual dollars. Next came the COVID lockdowns. We went from a $1 trillion deficit to a $3.1 trillion deficit. So spot the pattern. $600 billion deterioration in 2001, $1.25 trillion in 2008, $2.3 trillion in 2020. It almost doubles every time. So it is a ratchet. Where does that put our deficit in the next recession? Is it going to be $5 trillion? Will it be more? Of course, all of that is not even counting the soaring interest on the federal debt, which is much bigger, even in GDP terms, than it was in previous recessions. So today we're at $32 trillion. In 2008, it was just $9 trillion. In 2001, it was $6 trillion. Now multiply that 3 to 6 times bigger debt payments by the fact it could be paying much higher rates than previous recessions. Because in a normal recession, the Fed slashes rates to try to stimulate the economy. That reduces borrowing costs for the federal government for short-term debt. But this time around, if inflation is still galloping when the recession hits, the Fed may not be able to slash rates. All right, so what is next? In Herbert Stein's famous line, whatever cannot go on forever will stop. This next recession could be a financial reckoning on Washington's institutionalized Ponzi economy that could end up converting deficits into pure inflation via the Fed. Okay, we'll be watching. See you next time.